And it's time now to look at the big picture. And to do that, we're going to bring in our team from Charles Schwab. We've got Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab, and then Mike Townsend, who is Managing Director, Legislative and Regulatory Affairs, Charles Schwab. Gentlemen, thank you for joining me. Mike, I want to start with you because the top of mind this morning was the government shutdown that was averted. But was it really averted, or do we do the same thing in 45 days?
Oh, it's crazy town here in Washington, Renita, and we're going to do it all again in 45 days. But, this was a big surprise. It really came out of nowhere. It was a pretty stunning turn of events over the weekend, and Congress, at the last minute, passed something that keeps the government open until November 17th. President Biden actually signed it into law with just 32 minutes to go before the midnight shutdown. So pretty surprising turn of events. But, as you said, it really hasn't changed the dynamics that much. The underlying issues that are causing this squabble haven't changed a bit. They've just kicked the can down the road. So I think we're in for another round of this in mid-November. But for now, at least everyone can take a deep breath and pause and sort of recollect their thoughts.
Well, then what are some of those major issues that are still holding up a full spending bill?
Yeah, what's happening, Renita, is that the Republican-controlled House is looking for pretty big spending cuts, and the Democrat-controlled Senate just isn't going to go for that. So the House is using sort of different baseline numbers than the Senate is in terms of how to fund the government. So even if the House passes all these appropriations bills that fund every government agency and program, the Senate is just not going to be on the same page. And it's really, frankly, hard to see exactly how that gets ironed out. So I think that's why we're going to see both chambers try to move forward with their vision of how the spending should be allocated, and then those are going to run into each other again in November. So it's likely to be a replay in just a few weeks.
Mike, investors didn't seem to be shaken terribly by this information in the past week even. Is a shutdown actually something investors should be focused on?
Well, historically, shutdowns have not been big market movers, but I actually think the fact that it's moving to mid to late November is actually a worse scenario for the markets and for the economy. This will potentially be a shutdown right before we head into the holiday shopping season and spending season, and that could just create some uncertainty for a lot of people who, federal workers who are on furlough or something like that. So I think that's part of the incentive to try to get to an agreement, and I think you'll see both parties try to find a path forward over the next 6 weeks.
All right. Well, we will definitely keep watching. Jeffrey, over to you. Talk to us about market action you've been seeing today. It looks a lot like where we ended in the end of September.
Yeah, the story in the stock market today was the bond market. Bonds and stocks sold off today. The rate on the 10-year Treasury hit the highest level since 2007. That's not just pre-pandemic. That's pre-great financial crisis. It's been a long, long time since we've seen yields this high. 30-year mortgage is now 8% for a jumbo mortgage. So really incredible. I can remember people telling me, in the 70s, I paid, double-digit percentage rates for mortgages. Gosh, we're almost back there. So, this momentum has picked up on the sell-off side, and some of that was exacerbated today by Fed speakers. We had, of course, Fed Chair Powell speaking at a roundtable discussion in Philadelphia with Fed President Harker. We've got other Fed speakers. Governor Bowman, a known hawk, reiterated calls for multiple rate hikes today, and we've got a lot of other FOMC members speaking this week. We've got Mester in Ohio. We've got New York Fed President Williams at a conference in New York. We've got many of them speaking this week. There'll be no break from all the talking heads at the Fed, and that has really pushed the market towards repricing and the potential for another rate hike. Now looking at maybe a 1/3 chance of another rate hike at the next meeting. We don't think that's likely, but still that's pushed out. And Renita, what's maybe even more important is the higher for longer outlook for next year. The market's now only pricing in 50 basis points of rate cuts next year, starting somewhere maybe in the fourth quarter. That's a far cry from the 100 basis points starting early in the year that had been expected even just a month or so ago.
Where do you stand on the soft landing argument?
Well, I think there's a case in the U.S. for a soft landing, maybe in the services sector. Certainly, manufacturing is suffering. We've taken more of a nuanced view of the economic picture, one that shows that trade and manufacturing are indeed in a recession now. It's not really debatable. Factory output is down from a year ago and has been falling for quarters. Trade is as well. Exports are down. But at the same time, the service sector has done pretty well on the strength in the employment situation. We'll learn more about that, of course, on Friday, where it looks like we'll get another downtick in the number of new jobs created. I'll be interested in this earnings season, Renita, for what I hear from business leaders in the last couple of quarters. They've talked more about layoffs than they have about hiring. If that accelerates through the third quarter earnings reporting season, we could begin to get some concerns about the service sector begin to show up, which would start to look like a more traditional recession.
Definitely we'll be looking out for that. We've got jobs and jobs and jobs data coming out this week. But lastly, Jeff, anything that you're looking at on the international front?
One of the interesting, so international stocks really underperformed today. A lot of that on the dollar and concerns there about higher interest rates in the U.S. pushing that down. I'm watching oil prices. That's a global commodity market. We've seen oil prices dive back below $90 after money managers seem to have accumulated way very bullish positions. 15 long contracts for every short contract traded by money managers. We know 10 times more oil trades than is actually used. So it's a good indication of where supply and demand is. And it seems like they've been overly optimistic on the supply and demand situation. That's now shifting back the other way. We've got an OPEC meeting on Wednesday. I don't think they're going to announce that they're going to reverse any of those oil cuts, but I think there's maybe more risk to the downside in oil prices than we've seen for some time. That could affect global markets.
Okay, well, we'll keep a lookout on that. Jeffrey Kleintop and Mike Townsend of Charles Schwab, thank you both so much.